Ever wondered what happens when, a huge company, one with operations all over the globe in tons of different sectors, needs to put out just one single financial report? How on earth do you audit something that massive? Make sure it all adds up. Today, we're doing a deep dive into something called group audits. It's this really complex process for checking the financials of these big multi-part organizations, think subsidiaries, joint ventures, the whole lot.
Yeah, and our guide for this is a document looking closely at groupaudits.pdf, specifically focusing on IS 600 revised. That's a really important international standard here. Our mission, really, is to pull back the curtain, to understand the roles, the unique hurdles, and the very careful steps involved in making sure those consolidated numbers are accurate. It's like seeing how these giant corporations actually put their global figures together and how auditors make sure we can, trust them.
Okay, right. Let's unpack that. A group audit. It's not like auditing just one office building, is it? You're looking at the parent company, sure, but also all its components.
Exactly. Components can be subsidiaries, associates, joint ventures, even entities the group doesn't fully control. And the goal is always that one single audit opinion covering everything, the consolidated statements.
It sounds like trying to give one grade for a massive group project where everyone did their part separately.
That's a good way to put it. And you've got key players. The group auditor, who signs off on the whole thing, and often component auditors. These might be different firms, maybe local teams in different countries, auditing their specific piece. ISA 600 revised really pushes risk assessment. It lines up with other big standards like ISQM1, ISO 220 revised, ISA 315 revised 2019. So what does that mean? It means a big focus on professional skepticism, really questioning things, plus solid planning, lots of back and forth communication, and keeping detailed records. And importantly, component auditors. They're often in the loop from the start, not just at the very end.
Okay, so for you listening, this is about seeing how that one trusted financial number actually comes together from this, sometimes messy-looking web of companies. Now, here's where I think it gets really interesting. Picture being asked to audit one of these giants for the first time, or even just continuing the audit. What's the very, very first thing an auditor has to think about before they even say yes?
Well, before anything else, the lead auditor, the group engagement partner, has to figure out if they can realistically expect to get enough good evidence. Evidence about the consolidation itself, and importantly, about the numbers from all the different components. It's not a snap decision. They need to consider, okay, which parts actually need audit work? Do we have the people, the resources to do it properly? Maybe flying teams out. And what are the specific risks for this particular group? If there are already component auditors involved, the group partner needs to look closely at how cooperative they'll be, if they understand the ethical rules for the group audit, and frankly, if they're competent enough.
Wow, okay. So it's not just can we do the math, it's a whole strategic assessment, serious due diligence right out of the gate.
Absolutely, because saying yes kicks off a huge planning effort.
Right. So once they've decided, okay, we can do this, how do you even start planning something so potentially sprawling?
Well, a really big decision early on, especially if you're coordinating with component auditors, is figuring out which components actually need audit procedures performed. What's interesting is that ISS 600 revised doesn't give you a hard number like audit anything over X million dollars. It takes a lot of professional judgment from the group auditor. What influences that? Oh, lots of things. Any new companies bought or started, components that changed a lot recently, big deals between related companies, anything unusual popping up, or maybe analytics show weird fluctuations. Is there a risk they just can't get enough evidence from a certain place? Even looking back, were there significant errors or control problems found in a component's audit last year? It's all about risk, not just size.
So they're zeroing in on the potential trouble spots.
Exactly. And other huge planning points are setting materiality, both for the group as a whole and for individual components. Component materiality, that's the threshold for errors found in a component that must be reported up to the group auditor. The group auditor sets this, and it might be different from the overall group threshold. Planning also has to deal with non-coterminous year ends.
Meaning they don't all close their books on the same date?
Precisely, which obviously makes consolidation trickier. And they plan for handling changes in the group structure or if the structure is just really complex to begin with.
That difference between group and component materiality, that's smart. It means they're focusing effort where it's most needed, risk-wise. But with auditors potentially all over the world, different firms maybe, how critical is the communication aspect? It sounds like it must be the absolute lifeline.
Oh, it's fundamental. ISA 600 revised really beefed up the requirements here. It stresses continuous two-way communication all the way through the audit. The standard actually lists specific things they have to talk about. Like the group auditor tells the component auditor exactly what information they need procedures on. The component auditor confirms they did the work, confirms they followed the ethical rules. They have to report back any potential non-compliance with laws, any misstatements they found corrected or not, any signs of management bias, weaknesses in controls, any fraud or suspected fraud involving local management, other big issues they've raised or expect to raise with the component's management or board, really anything relevant to the group audit. And finally, their overall findings.
Okay, that's way more than just sending a report at the chain. It's an active, ongoing conversation.
It has to be. It's intensive coordination.
What happens if, communication gets sticky? Say a component auditor isn't playing ball or isn't providing what's needed.
Yeah, that's a real risk. That's where the strong planning and, again, professional skepticism come in. The group auditor needs those clear expectations set up front. If communication fails or the evidence isn't coming, the group auditor has to ask, can I still get enough evidence overall? Worst case, it could actually affect the final audit opinion on the entire group's financials. It shows just how linked everything is.
Right, every piece matters. And speaking of pieces coming together, the consolidation. Taking all those separate statements and making them one, what are the big risks here?
This is definitely a high-risk zone. Anyone auditing groups needs to really get the consolidation process inside out, because that's where mistakes can easily hide. For instance, if reporting dates are different, you might pull in the wrong figures. Simple error, big impact. Or if a company is doing group accounts for the first time, often higher risk right there, just from inexperience. Consolidation itself can be super complex, lots of judgment calls needed. Think about complex deals between group companies. So audit risk is inherently high. I remember one audit. Tiny subsidiary barely seemed significant, but a mess up in consolidating one intercompany loan nearly delayed the whole group's filing. Really drives home that you need to check everything, so thorough planning is just non-negotiable.
Makes sense. So what does the auditor do about that risk?
Well, the group auditor needs to understand the controls the group itself has over consolidation, like what instructions does head office send out. Then they check if those controls are designed well and actually working, can they rely on them? And this stage absolutely requires knowing the accounting standards cold. Things like IFRS 3 on business combinations, IAS 28 on associates and joint ventures, IFRS 9 and IAS 32 on financial instruments. It's like technical stuff.
So consolidation isn't just pushing numbers around in a spreadsheet. It's a major hotspot for potential errors that needs deep scrutiny. Okay, we've got the plan, the communication lines are open, we know consolidation is tricky. What about the actual legwork, the nitty-gritty audit procedures? What do they actually do?
Right, the procedures cover a lot of ground. They check how components are classified. Is it really a subsidiary? An associate? Correct classification matters. They confirm the numbers pulled into the consolidation actually match the component's audited statements. And crucially, that all components are even included. Nothing left out. They review all the required disclosures, related party deals, minority interests, things like that. They dig into how those components with different year ends or different accounting policies are handled. Are the adjustments right? And then there's specific evidence gathering for the really complex bits of consolidation, calculating goodwill and checking if it needs to be impaired. That's a big one. Canceling out all the transactions between group companies, accounting for unrealized profit on those internal sales, making fair value adjustments to assets and liabilities when a company is acquired, retranslating financials if a component uses a foreign currency. They're also looking for signs of impairment, say, if a subsidiary is losing money, does the goodwill associated with it need writing down?
And it's really vital the group auditor tells the component auditor exactly what evidence they need them to get, ideally right back at the planning stage.
That's a hefty checklist. So after all that work, potentially from many different auditors, how does the main group auditor satisfy themselves that the work done by the component teams is actually reliable? Can't just be taking their word for it.
Absolutely not. No rubber stamping allowed. ISA 600 revised puts a strong emphasis on the group auditor reviewing the component auditor's work papers, their documentation, and how much review is needed, while it links back to how much direction and supervision the group auditor provided all along. Professional skepticism is key here, too. they need to challenge the results. Critically look at management's judgments, especially in those gray areas like goodwill. Scrutinize how investments are accounted for. This isn't just about this audit. Finding issues might lead to improving the whole audit firm's processes, tying into quality management like ISQM1. And there are practical commercial things too, like weighing the cost and benefit of flying a team overseas versus relying on the local component auditor. These have to be balanced with the professional and ethical duties.
So it's a vigilant, critical assessment at the end, tying everything back together and ensuring overall quality.
Exactly, a critical review.
Okay, wow. We've really covered a lot today. We've journeyed through the whole group audit process, from that initial big decision to take it on, through the complex planning, the essential communication, assembling the consolidated picture, and then that final careful evaluation of all the work.
Yeah, we have. And group audits, they're just fundamental for these large, complex businesses. It takes more than just technical skill. You need rigorous procedures, constant dialogue, and that skeptical mindset throughout. They are absolutely central to how we, society, understand the financial reality of the world's biggest corporations. It affects everyone: investors, regulators, public trust.
And that leaves us with a thought for you listening. The next time you glance at a financial statement from some huge global company, take a second to think about the sheer amount of coordination, the critical judgment calls, the layers of expert checking that went into producing that single consolidated bottom line. What does that complexity hidden behind the apparent simplicity of a single report tell us about trust and verification in our financial world?